This is Tom Asbury with the Viper Report Market Wrap video for the week ending April 25th. Abbreviated report today since I've been fighting technical difficulties. But I wanted to point out a very rare signal that occurred last week that I've discussed in the past in my articles. And this page here from Forbes was an article I wrote October 9th of 2023 about the seventh buy signal from the Zweig breadth thrust indicator since 2000. If you remember 2023, everyone was expecting a recession because of the inverted yield curve. Sentiment was very negative on stocks, continued that way throughout the year. Let's look at some charts. This chart of the New York Composite has the breadth thrust indicator that's available in stock charts. The formula is on stock charts, or actually in my articles. It keys off the fact that the advanced decline ratios hit a very oversold reading and then zoom to a very overbought reading within 10 days. You can see back here in April, we just had a sharp decline. We cleared around for a while and then rallied sharply into July, where we formed a key reversal that we talk about on the website, and a prolonged decline. Well, what happened after the decline was over? In October, the sentiment, this last plunge in here, was really vicious. Some of the generally correct market technicians started to waver a little bit in here, but then lo and behold, November we got another Zweig breadth thrust signal, and you can see what happened after that. So just last week we got another bullish signal. So despite the chaos caused by the current administration and the generally very low, historically low bullish sentiment, I think this is a significant turn. This was the article I wrote in November 7th of 2023, pointing out this was the first double buy signal since 1962. You look at this chart, you'll find it pretty amazing. So, we had a huge decline in the summer, July of 62, formed a bottom here, rebounded back up pretty substantially, then had another decline into early November, where we got the ZBT buy signal on the 5th of 1962. Pretty nice move higher after that. Now, I know I've been talking about the bullish outlook for the market pretty much since the fall of 22, but and the bullish stats, thanks to my colleague Ryan Dietrich, really supports the importance of the breadth thrust. Ryan does really nice work, so if you're on Twitter, I would suggest you start following him. But you can see back here, if we go into, the 331.23, this 3-month 8.4, 6-month 4.4, 26.8. The longer term projection for the breadth thrust, you can see that the average is 23%, and it's been 100% correct. So we got in November, it was 19% up in 6 months, 32.7 in 12 months. So now we have this new April 25th. We'll see what that brings, but I think it does, favor and urges you to favor on the long side of the market at this point in time. Let's run through a few of the charts. This is the New York Composite Weekly. You can see this long tail here. We talk about tails. You can see the bottom of that tail was right back into the trading in early 2024. The volume was pretty strong yesterday, so we've had 3 weeks up, since the big plunge here. The stock's only AD line has turned higher, but still below its moving average. The all AD line has turned back to positive. That's a good sign. What about the other AD line? This is the weekly chart of the SPY, showing you we broke this uptrend, this line B. We've rallied just back to it. So for those who are bearish in the market, are going to say, aha, that rally is over. And that could, cause some pullback in the week ahead. Depends whether the duct tape falls off the administration's mouth or Twitter account to a certain extent. But you can see the AD line here. It's really been holding its moving average, still below this peak. That's the divergence we've been warning about for a while, because this key support level, if we drop below that, then that, in my version, would reaffirm the negative divergence or bearish divergence. Sentiment still extremely low here. The bull minus bear minus 33.70 last week. The weekly analysis of the Qs. Qs were up 6.4% last week. You can see very bullish in the AD lines, turned up from its moving average and suggesting a resumption of the uptrend. You can see we already made new highs back early in the year, so it looks very similar that we'll take out those highs. That would mean that we eventually will take out this 540 high in the Qs. Relative performance, measures how it's doing versus the SPY. It's back above its moving average, so that's a good sign. A breakout of this upper trading range would confirm that the Qs are again leading the SPY. The daily analysis of the Qs shows that we've made it above that prior peak at 465, but we're still below that pivot at 479.51, and more importantly, we're still below the yearly pivot. So that trend analysis is still negative. Would not be surprised to see if it flipped back to positive this week. The daily AD line broken its downtrend. That's a sign that the correction is over. We'd love to see a pullback in towards its moving average in the week ahead. And the relative performance shows it's just testing key resistance here. And of course, a move above this line D will be another confirmation that the Qs are leading the SPY higher. The relative performance in the Qs is consistent with what we're seeing in the growth value ratio. So we broke this uptrend line B, had a brief drop down, but now we're back above that uptrend. A close back above the moving average would say that growth is still can be in a leadership role. Of course, we have these twin peaks up here. So my advice going forward is to concentrate on those markets that have the best technicals, whether they're really a true value or growth ETF or stock. MACDs trying to turn higher, take another couple of weeks before they could flip back to positive. Looking at the daily chart of the Spider Trust, you can see we've cleared this line A. So we have the 50-day at 561, the pivot 567, and we did close the week back above the yearly pivot. You see the S&P 500 AD line, of course, most of the last year or so it's been leading prices, so it's just made it up to this resistance. Was a bit lower, on Friday. So, we'd like to, a pullback to the moving average would be okay. We wouldn't want to see it drop below this low. Stocks only on a daily basis, is above its moving average, but still below this key resistance. And as we mentioned before, I think the AD is all AD line for the NYSE. It's broken the downtrend here and has more important resistance here that needs to be overcome to give an all clear sign for the intermediate term. The 100% analysis shows exactly what that chart shows you, that for the SPY on Friday, 18% of the stocks were lower on the day. 1500, 13% were lower, and QQQs, 30% were higher. Yeah, we'll probably do something special, but this is a very interesting pattern. So I got very significant oversold levels. For the Qs, we got two that were below, greater than 90% down days, and then this burst of upside after a reaction that translates into what also triggered the breadth thrust signal. Some of the other indicators have been warning us in the past month or so, high, low, etc. Still a low number of new highs, 23, but no pickup in the new lows. That's a good sign. We wouldn't want to see the new lows on the NYSE get back above 200. NASDAQ says the same thing. VIX, VXN, are also in downtrends. That's all positive. A quick look at the watch list and the sector review. Based on the percentage of the stocks above their quarterly pivots, there are only a few positive sectors. The most positive is XLU, 75%. It was 83 last week, 41.7 in the XLRE, that's REITs and real estate. XLC has improved, went from 16% last week to 41 this week. Also improvement in XLK and in XLF, but they're still below the 50 level. Both XLY and XLP are right at 50. So you look at these on a 6-month basis, XLC is the strongest, up 4.4%. XLF is up 1.8%, and XLP is up 1%, but the S&P is higher than that. It is lower, rather. So if we look at some of the inverse signals last week, this chart is of the SPXL, that's the triple leveraged S&P. Got negative here in the latter part of March. It was also negative up here, moved sideways, got another sell here, and it just stopped out that on Thursday. That's also the case on the 260, turned positive on Tuesday. So that's in line with a further rally. Though the 260 could flip back to negative on any kind of pullback, it definitely gives you a positive cast on the weight of the evidence. Still not as much green on the sector analysis as the sector ETF report. So XLK, XLY, and QQQ all gave 3-day buy signals last week, as well as positive relative performance. Other than that, there's only XLP and GLD have daily, 3-day, and weekly at this point. So we'll be looking for some changes in those in the week ahead. All these DTSs will looking for new 3-day signals to confirm our analysis. RS looks pretty interesting on consumer discretionary. Don't think this is quite as bad as it looks, but we'll keep an eye on the consumer staples. They did drop back below its moving average. OBV and RS are not bad. Technology does look pretty strong. It looks stronger than the RS or the OBV on XLK, but this is, you draw a downtrend here, you've broken that downtrend. Communication, XLC, is sort of still in the sideways pattern here, so we'll keep an eye on it. A look at the sector report shows you all these names: Google, CHTR, JPM, WFC, GS, Morgan Stanley, MS, BA, GE, ETN, Microsoft, Broadcom, CRM, Equix, Tesla, Bookings, and CMG all gave new 3-day buy signals at the end of the week. We had another technical glitch there, so time is short. I want to get this out so you can see it tonight before tomorrow's open. You know which sectors I'll be looking at, and those of you who are subscribers and get the full weekly stock or ETF reports, be sure to keep sending me your questions. I will definitely respond to them. Thank you very much for tuning in.